All right, guys, let's go ahead and explore Unit 5. We're going to talk about some other investment vehicles like options, a couple different mutual fund securities that are out there. We'll talk about DPPs, REITs, ETFs, and ETNs. So a lot of different products in this particular unit, starting with options. Now with options, guys, there's two parties in a contract. I always like to think of it like a bet, okay? If I'm going to bet you that the team's going to win tomorrow, right? You're going to say, okay, I'll bet you because you think your team will win tomorrow. In these options, that's really all we're doing is making a bet. In an equity option, I'm saying, I'll bet you that the price of that stock will either go up in a call or go down in a put. And you're not agreeing with me. You think that the price will go down if you're going to sell a call, and you think the price will go up if you're going to sell a put. Okay, so it's just two people entering into a contract. So when we're referencing the buyer or the seller, we're referencing them buying a contract or selling a contract, not necessarily buying a security or selling a security. Okay. When we talk about the difference between the calls and the puts, it'll explain what the responsibilities are for each person in the contract. But the buyer is buying an option contract. The seller is selling an option contract. Whether it's a call or put designates what happens in the contract. Got it? And of course, the seller is always going to have the opposite attitude of the buyer. If the buyer thinks the market's going up, the seller is going to believe it's going down, or they wouldn't make the bet. Right? If I say my team's going to win tomorrow and you go, oh, that's my team too. We're not going to bet. Okay. All right. Now, investor A, the person who's buying the contract, there's some synonymous terms to them. So I want you to be really careful and I want you to make sure you know them. Okay. The buyer is long. They're the holder. They pay the premium. They have the right. The seller on the other side of the contract is short. They're the writer. They receive the premium and they're obligated. Excuse me. So what I want you to do is make sure that you get yourself some blank index cards, make some flashcards with this information so that you remember these synonymous terms for the buyer and the seller. It's very important. All right. Now, an options position will be stated as follows. You're either going to see an L or an S. This naturally is referencing long as the buyer or short as the seller. The number that follows that will represent the size of the option contract. 1 is 100 shares. It's referencing the lots. Remember LOTS? We talked about that in equity and in debt. And I said 1 lot is 100, 2 lots is 200, and so on. Next, you'll have a call or ticker symbol for whatever asset we're discussing here. In this case, it's an equity security, ABC's stock. Then we'll have an abbreviation of a month. That month will be referencing the month of expiration for the contract. This will always be 9 months from the time the contract is put into place. The options always expire at 12 p.m. on the 3rd Friday of whatever, I shouldn't say that. I guess it's not 12 p.m. 11:59. I apologize. That's my boo-boo. Oh, Emma. Okay, so it's 11:59 p.m. on the 3rd Friday of the month. I apologize. I always think midnight, and obviously 12 p.m. is not midnight, 12 a.m. is, but 11:59 a.m. p.m. Oh, I'm sorry, guys. I'm not going to back up the whole video just for that, though. I apologize. You understood what I meant. It's midnight, 11:59, the last minute of the day, 9 months out from the time the contract's put into place. So whatever month is stated in the contract, it expires on the 3rd Friday of that month at 11:59 p.m. And that, by the way, is always going to be Eastern time. Okay, sorry about that. Little confusion on my part. I didn't mean to do that to you. All right. Then we have a strike price. That strike price will represent in a call what the buyer thinks the price will go above, and in a put what the buyer thinks the price might go below. I always want you to think of a call as call up and a put as put down. That's the buyer's perspective. If the buyer's buying a call, they believe the market's going up in value. If they're buying a put, they think it's going down. And then there'll be a premium. If there's one not named, you should don't worry about it. But in this case, you'd see a premium of 3 as an example. This is what the seller's willing to write, saying that they believe it would be worth. I always say, picture the contracts as if there's a blank spot and the seller gets to write in the premium. Like, okay, I'll accept $3 for every share to be obligated. So if it's 100 shares, then we know that this premium would be $300 that the buyer would put down to hold the contract in place. Okay? Sorry about that. I feel horrible when I do that. I don't mean to confuse anyone. Hopefully that was an easy confusion. If that's the worst that happens, right? All right, so here we have an example of a call. 1 ABC July 40 call. Now here we have the buyer, the owner, the holder, having the right to exercise that contract up until the July expiration. In a call, remember I said they wanted to go up, call up. So they want to buy those shares if indeed it goes above the strike price. The seller, the writer, remember the one that's short, they're obligated to sell their 100 shares that they own to the buyer at that $40 a share, if indeed the price goes up and it's exercised by that date. Now, think about that, right? Just sit back and think about it for a minute. The buyer wants to buy securities at $40 a share that the seller owns. Well, if that price goes to $90 a share overnight or $400 or whatever it may be, the seller's obligated to sell them to the buyer at just $40 a share. How about that? Of course, the seller doesn't want that to ever happen because they want to be able to just sit back and keep the $300 that was the premium that was paid. Then we have a put. Remember, the buyer put down. The buyer thinks the price is going to go down. In other words, they own the securities as the buyer, and they want to be able to sell their securities if the price starts to decline. You see, the buyer's always looking for the hedge. They're looking to be able to buy when the price is going up or sell when the price is going down. The seller just simply wants the premium. They don't want to have to do anything. Okay, so here the buyer, the owner, the holder, the one that's long, has the right to exercise the contract up until that July expiration date to sell their 100 shares of XYZ stock at 40 a share. The seller, the writer, the one who's short, would be obligated to buy those 100 shares at $40 a share if indeed the price goes down. That contract would be exercised by the expiration date. Now think about that. Sit back and think about it. I own shares and they're coming down below $40 a share. Let's say all of a sudden they drop to $3 a share, company's going under. Well, I, as the seller on the other side of the contract, would have to buy those securities at $40 a share because that was the bet I made. But of course, I don't want it to ever go down. I think you're an idiot in the contract, right? I don't believe the market's going down, or I wouldn't bet you. Just like you wouldn't bet me if you didn't think your team was going to win. So ultimately, I don't want to have to do anything but keep the money that you put down as the premium. You got it? Pretty easy stuff when you think about it, right? You just got to have it explained the right way. Now, a lot of the questions on your test will be able to be explained by a simple Foursquare. Now, I kind of taught this Foursquare to myself when I was studying, so bear with me. I learned a long time ago that if I use things I already know in life to explain things that are more difficult for me to understand, then it's easier for me to remember, right? So I was raised on a farm in Western Pennsylvania, and I know that bulls were always bigger than bears. Okay. Now, of course, we know bull or bull market means that the price is going up. Bear or bear market means the price is going down. But these are reflecting the attitudes of the buyer and the seller. Are they bullish, believing it's going up, or are they bearish, believing it's going down? Now, the bulls always gave us a whole lot of BS that we had to clean in the barns, in the stalls. And for the purpose of this test, that is the buyer and the seller. C comes before P in the alphabet. That's calls and puts. And the opposite underneath. Nice and simple. Wouldn't you agree? Here, if I'm told that my customer is bullish, that I'm going to recommend that they buy calls and sell puts. Here, if I'm told the customer is bearish, I would recommend they buy puts and sell calls. Do you see it? Okay, so a bullish person buying calls, selling puts. I'm trying to get a different color here. A bearish person buying puts, selling calls. See how easy that is? Okay, it only takes a minute for you to write. And the only thing that might come into play that might confuse you a bit is this, the synonymous terms. They might say long calls and short puts, right? So that's no big deal. We know the buyer is long. We know the seller is short, right? We know that the buyer has the rights. We know that they get the money. Pay the money. Jeez Louise. Whereas the seller is short, they are the writer, and we know that they receive the money that we call the premium. So just in case we need to add those synonymous terms, we can always do that. That's not difficult at all. Next, we move on and we talk about what we call intrinsic value. Intrinsic value has to do with if the buyer has value in a contract. So in a call, we want the value to go up in price, right? So if it's at $40 a share for the strike price and the current market value is up here at 60, then there's value in there, isn't there? We call that intrinsic value. And in this case, the intrinsic value would be 20. If it's a put, we want it to go down. So let's say our strike price is 30. And let's say that the current market value is down here at 26. There's value there, isn't there? $4 intrinsic value. So I have a lot of people that just try to memorize this chart, but I'd rather you have an intimate understanding of it. So just use your hands, maybe, like looking at it. If the current market value is above the strike price, greater than the strike price in a call, then it's in the money. If the current market value is above the strike price in a put, then there is no value. It's out of the money. When the current market value is equal to the strike price, you should have your hands pretty much held up side by side here, right? At the same level. It's at the money, whether it's a call or a put. This is when a buyer would start to think about exercising. In a call, if the current market value is below the strike price, it hasn't come up yet. So it's out of the money. There's no value for the buyer yet. In a put, if the current market value is below the strike price, that's a good thing. That means it's going down like the buyer wanted. That's in the money. That has intrinsic value. Okay, so just picture the call up, the put down, and imagine what's going on there. And you can easily state if it's in, at, or out of the money. And of course, however far in the money it is, that's the intrinsic value. There's no such thing as intrinsic value when it's out of the money. Intrinsic value is never a negative number. All right, let's take a look here. Remember, I said intrinsic value is only referencing the buyer. The seller would never have intrinsic value in a contract. But what they do is they'll throw it in here. You have to know that it's just window dressing, right? That really doesn't matter. And in all honesty, none of this matters. Whoops, sorry, I didn't mean to do that. All we want to know is the strike price and whether it's call or a put. So here, as the buyer, I want the call to go up, don't I? And indeed, the value has gone up. So it's in the money, isn't it? It has intrinsic value of 5. See it? Here we have a put. I want it to go down. Well, the current market value is still way up here, so it's out of the money. There is no intrinsic value. Here we have a call. I want it to go up. 55 is my strike price, and it happens to be at 55. That's at the money. There's no intrinsic value yet. It's at the money. Here we have an 80 put. I want the price to go down. And here we can see the price indeed has come down. It's in the money by $20. That has intrinsic value. So when it's at the money, there's no intrinsic value. When it's out of the money, there's no intrinsic value. Only when it's in the money is there intrinsic value. And however far above the strike price the current market value is in a call, or below the strike price in a put, is how much intrinsic value is in the contract. Then we have something called time value. Now listen very closely. Time value has nothing to do with the actual time until the contract ends, as much as the fact that there is time until the contract ends. Now, our ultimate goal here, if I take a call, 40 call, I want it to go up, and I pay $8 for it, I want it to become what we call a break even. So I would do 40 plus 8. So 48 is really where I'd like to get to. All right. So here going up, it's at 45. It's in the money, but it's only in by 5. I want it to get to 48. So I still have 3 to go. That's my time value. Let's go to the next one here. 75 put. I want it to go down. 75 and I pay $6 for it. In a put, I'm going to subtract that number. So 75 minus 6 is 69. That's where my break even is. That's what I want to get to. The current market value is still way up here. So it's not in the money. There's no intrinsic value. However, I still need to make up that $6 below the strike price. So I still have time value of 6. Time value is not taken from the current market value. It's taken from the strike price. We don't care when it's out of the money. This would be not even something to think about at that point. Here we have a September 30 put. We want the price to go down. 30 minus 4, 26 is where we want it to get to. Well, hot darn, it's there. Look at that. The current market value, we broke even. It's got the intrinsic value that matches the premium. We call that trading at parity. Okay. So when this number and this number are the same, that's called parity. There's no time value because we've reached our break even. We're happy there. This is when we would exercise for certain. Then we have a CHS March 60 call up 60 plus 5, 65 is going to be our break even. The current market value is below 60. So it no longer matters. There's no intrinsic value, but we still need to get 5 above that strike. So our time value would be 5. You got it? You might have to watch that a couple times. Okay. Just know that the current market value lets us know if it's in the money, at the money, or out of the money. How far it's in the money tells us the intrinsic value. And if we need to get further to break even, then how far do we need to get as far as points would tell us the time value. So remember, I said in a call, we're going to add call up, call addition, okay? So here we have March 60, call it 4. We're the buyer in this case, we're long the contract. 60 plus 4 tells us that our break even will be 64. If I'm buying a call up, I have a bullish attitude. I think the market's going to go up. Therefore, I'd like the right to buy the securities if indeed it does so. If indeed it does so, I get to buy those securities, which could potentially become worth unlimited numbers of money. So my maximum gain would be unlimited. And my maximum loss is this guy right here times the one lot of 100. I lose the $400 if it never comes to fruition. Now you might say, how'd you know it was 100? If it doesn't tell you a lot, assume it's 1. Then we have short calls. Here I'm the seller on the other side of that same contract, right? Remember I said the break even only applies to the buyer. So technically the break even would be the same for me, right? The break even is always going to be up premium plus the strike price in a call. But I don't believe the market will go up. I have a bearish attitude. I went ahead and accepted that $400 to be obligated in the case that it does indeed go in the buyer's advantage. My maximum gain is that it never does go above 60. Therefore, it's never exercised and I get to keep the premium. My maximum loss is that I have to sell my securities to you that potentially could be worth an unlimited amount of money. So here you can see it a long call versus a short call. If the break even is equal, or excuse me, if the premium plus the strike price is the break even, we know that's always going to be the same. For the buyer, the maximum gain would be unlimited if the premium is above the strike price. Excuse me, if the current market value is above the strike price. They're kind of stink on that, don't they? This should be referencing the current market value here. Okay, so if this is the strike price, if the current market value is up, then the maximum gain is unlimited for the buyer and the maximum loss is unlimited for the seller. If it's below the strike price in a call, the maximum loss is the premium for the buyer. The maximum gain is the premium for the seller. That makes it pretty simple, doesn't it? All right, let's take a look at buying a put. Remember, if I'm going to buy a put, I want the price to go down. So I would take that $80, subtract the 7, and that gives me a break even of 73. You see, as the buyer, I believe the market's going down, put down. I have a bearish attitude. So I would like to have the right to sell my securities if indeed the current market value falls below that $80 a share. My maximum gain is that you indeed would have to buy my securities from me. Now let's think this through. It's 100 shares at $80 a share. Well, that's $8,000, isn't it? So if I get to sell my securities to you, you have to pay me $8,000. But did I gain $8,000? No. Why? Because I already paid you $700 to leave the contract in place. Therefore, my maximum gain would only be $7,300. We have to take that premium into consideration. My maximum loss is that it never indeed falls below the 80 and you get to keep the premium you want. On the other side, the person who's bullish that doesn't think the market will go down, the seller, remember I said the break even will be the same because really it's just a buyer that has a break even. So you as the seller are bullish. You don't think the market will go down, but you accepted that 700, 7 times 100, right? You accepted that 700, you accepted the premium to be obligated. Your maximum gain is that the market never does fall below 80 and you get to keep the premium. Your maximum loss is that you have to pay out that $8,000. So remember, 80 times 100, 8,000. But did you lose 8,000? No, because remember, you gained 700. They had to give you the $700. So technically, all you lose is 7,300. So here again, if this is the current market value, all the way down to 0, right? Maximum loss, maximum gain for the buyer versus the seller in a put. All right, now we just talked about what we call equity options, but there's index options, which means we're going to make a bet on what the index is going to do. How do we make that bet? Well, we do it in points. Every point that we bet is $100. The strike price will be based on whatever index we're betting on, like the S&P 500 or the Barclay or the Wilshire or the Russell, okay? When the exercise occurs, the seller is going to deliver cash that's equal to whatever the intrinsic value is, however far above in a call or below in a put that the index fell or rose. So these are used to profit on market moves and hedge the market risk. A yield-based index option. This is when we're betting on index yields. Same thing, points. Choose to profit on interest rate moves and hedge against interest rate risk. Then, of course, we have currency options. Currency options are when we're betting on what the price of another country's currency will do. The strike price will always be based on US cents, but we're betting on foreign currency. It's used to profit on currency moves and hedge foreign exchange risks. So we have equity, which we talked about for quite some time. That's about the stock prices, a specific stock price. Index, yield-based, and currency are all based on movements that will occur that aren't on a particular product. All right, next we have a subject that might come up on your exam. And if that subject comes up on your exam, it'll have to do with whether exporters buy calls or puts or importers buy calls or puts. And here, just simply remembering this very, very simple word, right? We call this a, not a peg word. Oh, goodness gracious. Oh, an acronym, excuse me. I didn't think on that one. EPIC, E-P-I-C, exporters buy puts, importers buy calls. And that makes it really, really easy for us to remember. All right. Moving on to another concept that we need to understand is the American versus the European style exercise. So here you see that American options can be exercised anytime up until the expiration date. So A, American, A, anytime. Whereas European style options will only be allowed to be exercised on the expiration date, whatever date is named in the contract, the third Friday of the month at 11:59 p.m. Eastern time. That's when it expires. That's when it can be exercised, that day. E, European, E, expiration. All right, so let's think about what hedging positions are. Whether it's a stock position or an option position, you're always letting the stock position control. You're always hedging opposite whatever the market attitude is of the stock position. If you want to protect yourself, you're going to buy. Remember, I said hedging in options is the buyer, whereas if you want income, you would sell options. If we're trying to protect our position, if I own stock, then I would want to This is actually an incorrect slide. If I own stock, if I'm long the stock and I'm just looking for a hedge, then, oh yeah, no, that's right. I'm sorry. A long put, they're right. So I'd buy a put. That way, if the market starts to go down, you would have to buy my potentially worthless securities. Sorry, I thought of that wrong. That is a correct slide. Here, if I own stock, another way that I could position myself is to have a short call. You see, if I think the market's going to go down and you think it's going up, then I'm able to generate income because I believe that you're wrong. So if I own the stock, long means I own it, regardless to what I'm talking about. When we were talking earlier about long and short, we were talking about buying or selling a contract. Here we're saying we own the stock. So if we own the stock, I could sell a short call, which would allow me to get income if I'm right. Now, one of the things you might run into on your test as well is the option accounts. The option accounts, we have suitability. We have to discover if the customer is suitable. At that time, before the account is open, we have to give them a disclosure document. This is sometimes referred to as an ODD, the option disclosure document. Once I've given you that document, the options principal can approve the account and we can go ahead and start to trade. But this agreement, this ODD, must be returned by the 15th day after the account's been approved. So the ODD must be returned by the 15th day after the account's been approved. If it's not returned, with you stating that you understand what position you're taking in this contract, then all we can do is close our positions. No more trading would be permitted in the account. I really don't understand this slide specifically as far as the facial expressions, because we really have no way of knowing who's going to win in this bet yet. But what they're basically saying is the buyer is going to contact their broker dealer saying that they'd like to buy an option. The OCC will be contacted. That's the Options Clearing Corporation. And they will randomly find a broker dealer that will then find a seller for that same security, that same option. This will be randomly chosen. First in, first out, meaning you're in line, whoever's next, or any other fair method that the broker dealer chooses. They certainly can't show prejudice in any way for their wealthier investors or their family or something along that lines. They could not do that. All right, let's go ahead and look at some municipal fund securities. We've got our 529 plans, pretty simple. These are educational savings plans for our children. The way these work is this center column will all be the same. They're all after-tax contributions. They all allow tax-deferred growth. The distributions can be tax-free as long as they're used for educational purposes. And although they are the property of the person putting the money in, the donor, if the donor were to pass away, they do not become part of the estate. They don't go through probate. The two types are savings and prepaid tuition. Savings plan carry investment risk and can be set up in multiple states. You could choose any investment account to put this into. It could be a mutual fund, with anybody. Whereas a prepaid tuition account can only be opened in the state of the residence. It could be transferred to other schools in other states as long as those schools accept it. And it offers inflation protection. Typically, a question on the exam will be about the prepaid. And it'll usually say something like this: John and Sarah's little son, Billy, is going to go to their alma mater. They're concerned about the rising tuition costs, and they don't want to take on any market risk. What would you recommend? Well, that would definitely be the prepaid tuition plan. Then we have our LGIPs. These are local government investment pools or plans. The LGIP is established by states. It's kind of like a money market for cities, counties, school districts, all local and state government types of entities. This allows them to make short-term investments. Let's say that a school district gets money and they want to buy new iPads for all the students, but they want to do it next year. They would probably use an LGIP to put that money away, very safely kept, still able to earn some money until it comes time to use that money. Then we have something called Achieving a Better Life Experience account. This will usually be listed as an ABLE account, ABLE. These are designed for any fully disabled person that was deemed fully disabled prior to their 26th birthday. Regardless to the age they are at the time of opening the account, were they deemed fully disabled prior to their 26th birthday? If so, they have a tax advantage savings plan here. The beneficiary will be the account owner. Whoever the disabled person is will own the account. Anybody can put money into this, and the income that's earned by this account would not be taxed. The eligibility requirements, as I said, must have been deemed fully disabled prior to their 26th birthday. Next, we have our partnerships. We call them DPPs. DPPs come in two forms. It's either a general partnership or a limited partnership. In a general partnership, all partners have the same liability. Rarely is there any test questions on that because it's really easy to remember. The limited partnerships will have one general partner and multiple limited partners. Only the general partner will have unlimited liability. You see, a general partner in a DPP in a limited partnership gets to make all the decisions. So the limited partners will have limited liability because they can't be responsible for decisions that they had no way of making. So that's one of the big things that'll come into play as far as a question on the test. The different types, we've got real estate DPPs, we've got natural resource, and we've got equipment leasing. The real estate DPPs will usually have a trigger that it's tax deductions. Okay, tax deductions for you to be able to, sorry, I'm trying to move this back down. I didn't want hedge funds to be showing yet. So it would be tax deductions for real estate, buying the real estate and maybe fixing it up and selling it again, government grants for low-income housing, things like that will usually point to a real estate DPP. Under natural resources, their trigger will usually be, oh goodness, IDCs, intangible drilling costs. This is things like gasoline, insurances, wages, things like that, the cost to be able to drill for natural resources such as oil and gas. Last but not least, we have equipment leasing down here at the bottom. Equipment leasing, they'll usually use the word obsolete or obsolution, right? Obsolescence, talking about the fact that when we're leasing equipment, let's say we're leasing computers, they're going to very quickly go out of date and they're going to need updated, right? So any type of equipment will need to be updated. That's a big risk in an equipment leasing DPP. So those are the triggers for you. When it comes to taxation, there are tax reporting agencies, but the agency itself, the DPP itself, does not pay taxes. Each individual pays taxes, each partner. So all the business results, whether it's a earnings or a loss, are going to pass through to those individuals in the DPP. So the partnership will report, but they won't pay. Each individual will be responsible for paying their own taxes. One of the big risks with DPPs is the audit risk, mainly because when we're looking to write off things like depreciation and depletion allowances for equipment and things like that, if you and I are both in a DPP and we both try to write off the same depletion allowance, that of course is going to perk up the ears of the IRS and cause an audit. So audit risk is a huge risk in DPPs. They're also extremely illiquid. Then we have our hedge funds. Guys, hedge funds aren't regulated, so they don't fall under that Investment Company Act of 1940 that we talked about, in the last unit. So the Investment Company of 1940, remember, classified it into different categories: UITs, FACs, and management companies. Hedge funds don't fall under any of those. These are not regulated by the SEC. They do use very aggressive types of investment techniques like short sales, portfolio purchases on margin, currency and commodity speculation, and using derivative products known as options, puts and calls. Hedge funds are generally only suitable for those sophisticated investors. Remember in Unit 1, I said sophisticated, accredited, qualified, savvy. Those are all words that would describe a sophisticated investor. Hedge funds generally have very high fees. Managers typically will pay themselves bonuses out of the hedge fund. And typically they'll have a lockup period of about 18 months, which of course provides very low liquidity for the customer who's placed their money in there. Finishing up with REITs, ETFs, and ETNs. REITs are real estate investment trusts, equity REITs, mortgage REITs, and then we have something called a hybrid, which is a mix of mortgages and properties. The hybrid REIT will typically fall under Reg D. Remember that from the first unit, that's a private placement. Equity REITs are a portfolio of properties. So the REIT would get their money from income from rents and leases. A mortgage REIT is going to get income from mortgage interest. They're going to loan money out for people to buy mortgages or buy property, excuse me. And Reg D, the hybrid, the mix of the two, is going to have income derived from both sources, both rents and interest. So these are not a DPP. Remember, we just talked about real estate DPPs. These are different. The losses, the deductions, the depreciation, all of those things are not going to pass through to the investors of a REIT like they do to the investors in a DPP. Most REITs are listed on the exchange. However, there are private REITs, like I said, Reg D, which are non-registered. Publicly traded REITs that are on the exchange are very liquid, whereas private REITs, not so much. Remember, I said DPPs lack liquidity? Well, a listed REIT has liquidity. Major difference between the two. Exchange traded funds, I always say that these are the crazy rebel child of the mutual fund family. They're legally classified as an open-end management company, as a fund, a mutual fund. However, remember how mutual funds don't trade in the secondary market and their pricing is based on forward pricing? Well, here an ETF is based on continuous pricing. It's trading throughout the day on the secondary markets. These types of funds are allowed to be margined, whereas mutual funds are not allowed to be margined. There's generally not going to be any dividends or capital gains paid out, so there's no tax consequences until the shares are sold. And that's usually looked at as an advantage to the investor because they don't have to file taxes for this particular fund every year. Very low expenses and very low operating costs. But these are considered commissionable transactions versus our mutual funds that we already learned about, which have sales charges. Remember, NAV plus SC equals POP? These are commissionable. So a frequent trader would pay a commission every single time. Therefore, it would impact them adversely. Last but not least, we've got our ETNs. These are exchange traded notes. These are a senior security. They're an unsecured debt, but they're issued by banks. Remember, we talked about notes that were issued by the government, right? T-notes. Well, these are issued by banks. They're a debt-like instrument that's going to pay all the interest at maturity, but the interest is going to pay out based on the performance of like an index or some other reference, like a basket of stocks or the consumer price index or something along that lines. The primary risk of an ETN is the issuer defaulting. Due to the very complex calculation for the interest, ETNs are only suitable for a sophisticated investor. Sophisticated, accredited, qualified, savvy. Got it? All right, guys. Go ahead and get finished up here with Unit 5. Make sure that you have read and or listened to the unit to fill in all the blanks that I don't fill in on my slides. And make sure you get your takeaways done if you haven't already done that. Okay?